You remember Groupon, right? It was a tech darling in the 2010s that offered daily deals and discounts for local businesses. But since its historic initial public offering in 2011, the company's stock has fallen 99%, from a market cap of $13 billion to a mere $120 million in the subsequent decade. So today, we're gonna figure out whatever happened to Groupon. We'll explore the history of this e-commerce giant, from its rise to become a billion-dollar company to its struggles with oversaturation in the daily deals market. If you're interested in learning more about the world of business and personal finance, make sure you subscribe so you can find out more things like why meal kit delivery services are actually a ripoff and what credit card you should be using in 2023. But for this video, sit back, relax, and let's deep dive into the rise and fall of Groupon. Let's start with the rise of Groupon. It began back in 2008 with an innovative business model. Groupon was one of the first companies to introduce the concept of daily deals. These daily deals consisted of discounts and promotions for local businesses. Groupon started offering their deals in Chicago, and Chicago was an amazing place to start because Groupon could focus in one area until it got on its feet, and the size of the city allowed it to continue to grow quickly once it actually got going. The daily deals and local model appealed to both customers and merchants and helped to drive rapid growth. The local business owners liked it because it increased consumer traffic, and the customers loved saving money and trying new places. It was a win-win. In 2013, in order to accelerate growth, Groupon redesigned their website and offered 1 million random customers up to $5,000 in Groupon bucks, which was money that those customers could use by the end of the year on any sponsored deals. This offer bumped up consumer traffic and really incentivized people to use Groupon more, which helped contribute to its quick rise in popularity. Making everything so accessible online in a condensed space was also a huge improvement to the former traditional couponing method. Previous couponing was mostly by paper and had to be collected from various sources and physically brought around. Making things online like Groupon did made deals easier to bring around with you. All these features drove millions of consumers to the site. This created a positive feedback loop. As more customers signed up, more merchants were willing to offer deals through the platform. Users loved the experience with Groupon because it was so simple to find and use the deals. And if there were ever any issues, Groupon had a strong customer support team. Groupon's growth was crazy fast at the time. As you can see by this chart, Groupon had over 50 million active users within only 5 years of starting. Overall, Groupon's early market dominance and innovative business model did help it become a multi-billion-dollar company, and at its peak, Groupon's market capitalization was around $13 billion. For perspective, that's a higher market cap than Albertsons, Domino's, and Qualtrics have today. But with time, its market cap fell as Groupon's market waned. Groupon peaked in 2014, and after that started to fall in popularity. There were also some major jumps up and down and a huge decrease around 2020, so let's talk about it. For one, the market began to get way too saturated in the daily deals market. Competitors made it really hard for them. For example, Living Social, another daily deals site, which actually started in 2007 right before Groupon did, grew to become a major competitor. Looking at the two sites now, they even have many of the exact same deals across the sites. In addition to these kinds of platforms, major retailers like Amazon and Google also entered the daily deals market, making it even more difficult for Groupon to differentiate itself. Other sites like ShopTagger, which recently rebranded to Karma, and Honey also rose in popularity. These sites will search the entire internet for you to find coupon codes and list them all in one place or right where you're checking out. This saves you a ton of time and work and gets you the best deal. These created competition for Groupon because while Groupon offered local daily deals, it didn't actively scour the internet for you in this way. So oftentimes Groupon didn't actually have the best deals. As consumer behavior shifted towards online shopping and e-commerce platforms, the appeal of Groupon's daily deals became less and less compelling. But saturation wasn't the only cause for reduced use. The deals decreased because merchants just weren't satisfied. There was no way to guarantee the merchants that the customers would ever actually come back without a discount. There was a really low customer retention rate for customers that came from Groupon. And at first, Groupon didn't offer any way to limit the quantity of items or deals that the merchants would sell at the discount. So creating deals with Groupon was really risky. Some shops even went bankrupt because of how many items they sold below cost. A survey of 115 participating merchants showed that less than half of the merchants indicated that they would actually do the deal again. So merchants hesitated and many even dropped out. And without as many deals, less and less people used Groupon. Another reason why Groupon struggled was that it's just really hard to translate old ideas like coupons into a profitable business on the internet. For example, tons of people still read the news, but the income for the industry has fallen because there's so much free online access. The exact number is really hard to calculate because of how news is split between physical and online papers, as well as TV, radio, and even YouTube. But the point remains that becoming profitable for their own company, plus helping other companies make more money, has been really tricky for Groupon. These and other financial challenges hit Groupon really hard. The company kept shifting its focus between daily deals and merchandise and online services, and some would say that this made them do all of the above pretty poorly. Groupon has struggled at maintaining profitability, and as you can see here in the last 50-something quarters, Groupon has only had 7 profitable quarters. Because profitability was so fleeting and inconsistent, they had to lay employees off, and this sent their stock price even lower, and it harmed company morale. In order to try and stop their fall in popularity, Groupon focused on targeting millennials. For example, Groupon partnered with Snapchat in 2019 to offer exclusive deals to Snapchat users. However, that still wasn't enough to grow their user base. Finally, when COVID-19 hit in 2020, it greatly reduced Groupon's active users. The attractiveness of many of their deals declined as people couldn't go out in public to use them, especially because many of the deals were for activities, and Groupon deals usually weren't for online businesses. And obviously during the pandemic, people shifted away from in-person activities and toward online businesses. COVID really hurt Groupon by massively shrinking its user base. But Groupon did its best to pivot during the pandemic. In fact, in some ways, COVID helped the company grow. The trend towards self-care during the pandemic, as people looked for relaxing at home and less social activities, has helped Groupon create lots of different new deals. Groupon's wellness and beauty deals have become increasingly popular as people look for ways to pamper themselves at home. Just look at their website today and you'll see lots of deals for at-home care and massages. Groupon has really tried to spark growth by expanding internationally, but they face some major difficulties in adapting to local markets. Some countries had regulatory challenges or rules by various governmental systems that really stymied growth. While Groupon at its peak did offer services in around 28 countries or so, it now looks like they only coordinate deals in about 12 countries outside of the United States, including Australia, Belgium, France, Germany, Ireland, Italy, the Netherlands, Poland, Canada, Spain, the UAE, and the United Kingdom. So they might have stretched themselves a little too far and might have been better off focusing on their home market or just fewer international markets. In the end, Groupon's decline can be attributed to a combination of factors. The market got too saturated, the merchants weren't satisfied because the customers didn't return, the deals were hard to limit, which meant that merchants began to make deals less appealing, which consumers really didn't like, and then COVID got in the way. Sure, targeting millennials and shifting to more self-care deals has helped Groupon a bit, but they still look pretty forsaken. And in total, Groupon is still down 99% since its initial public offering in November of 2011. Despite its challenges, Groupon remains a well-known brand in the coupons and deal industry. But let me know in the comments what you think was the biggest reason for Groupon's decline. Thank you guys so much for watching, and if you're still here right now, you probably enjoyed this video. So be sure to subscribe so you can see other videos like it that I make. I hope you guys have an absolutely great day, and I'll see you guys next time.